Good afternoon and welcome. I'm Chris Medland, and my colleague Bob Romanchuk and I are going to spend some time this afternoon trying to predict the future of executive compensation. We're going to talk through some of the key influences on executive pay, legislation, accounting treatment, what stakeholders think, and then we're going to try to give you our best predictions for the future. Bob is going to start us off by looking at the very different platforms of the Republican and Democrat presidential candidates.
Good afternoon. To start, let's consider what the platforms are of the presidential candidates, both Republican and Democrat, and they are somewhat opposite each other, and we'll consider what the impact of executive compensation might be. You look on the Republican side, from a tax perspective, the Trump side would lower corporate rates considerably from 35% to 15%, and also implement a 10% repatriation tax to get profits back in the country. Also, the proposal would be to collapse and lower individual rates down to three different 12, 25, and 33%, and there would be an elimination entirely of the state taxes. If you step back, consider what would the implications be on executive compensation. Clearly, your short-term and long-term performance plan goals will need to be adjusted, possibly higher for additional growth that these lower taxes are estimated to create, and also for large repatriated dollars possibly coming back into the country. From a $162 million deductibility limitation question, that deduction for corporations now is significantly less meaningful, with the corporate rate being dropped from 35 down to that 15%. And non-qualified deferred compensation programs continue to be unattractive, actually a little less attractive here with lower individual rates. Compare that then to the Democratic side. The tax stance just the opposite. There would be a 30% minimum tax for anyone who has adjusted gross income above $1 million, and then an additional 4% surtax on income over $5 million. So clearly would impact the executive population with both of those. Capital gains rates also proposed to be increased significantly. 6-year duration there, the rate would go up to as high as 39.6%, and carried interest would be taxed as ordinary income. Finally, the estate tax rate would be increased, the top rate to 45%, and the exclusion dropped down to $3.5 million. Consider the exec comp tax implications. As we've seen before, when income tax rates go up like this, it would be pretty typical for executive compensation pay levels to increase to somewhat offset the higher cost of taxes. And then additionally, voluntary deferred comp plans now all of a sudden become much more attractive than they have been in the past. So that clearly is one area that you should consider think about in the future, the design and implications to your non-qualified deferred comp programs. Continuing on with the presidential platforms from a Dodd-Frank perspective, the Trump side would dismantle nearly all the statute. Some of the things that he said are very negative for us, so bad banks aren't loaning, and it's one of the reasons that we have no growth. Consider the exec comp implications. The CEO pay ratio in particular, although we know this is already finalized, very interesting, the implementation date was delayed until 2017 for the first public disclosure in 2018. You wonder whether that was a purposeful delay so that after the election, whoever the new administration is would have a possibility of repealing or modifying that. Somewhat uncertain. If you look at the other Dodd-Frank exec comp rules still not finalized, the clawback hedging pay for performance, that seems a complete repeal really is only going to be possible if the House, the Senate, and the presidency all go to the Republican side. So compare that to the Republican to the Democratic stance on Dodd-Frank. So Hillary Clinton would extend the reach of Dodd-Frank, fight for more accountability that actually goes beyond Dodd-Frank, and would veto legislation that would weaken any financial reform. From an exec pay perspective, it appears certain that the CEO pay ratio would be here to stay, and the additional items, the hedging and the pay for performance disclosures, will likely be finalized actually probably fairly early in 2017, leaving the clawback policy. The guess here is that that would be implemented. It could be that final rules, we've got proposed rules already, but final rules actually could be more strict than the proposed one. So this is another area really to consider and look going forward, the clawback policy. There's been a lot of discussion out there on CEO pay ratio and whether, other than the presidential platforms, whether there's a chance that this possibly could be repealed. The U.S. Chamber of Commerce has announced publicly that it will not attempt to sue to vacate this rule as it did with proxy access on the basis that the SEC failed to conduct an adequate cost-benefit analysis. Likewise, the Business Roundtable has been insinuating for quite a long time that they too would take legal action to vacate. It seems now that the time has passed for them to do that, and the clear conclusion here is it appears that a repeal is unlikely, and so you should get ready to comply with the CEO pay ratio going forward. Going back for a minute just on the clawback here, if you consider and compare that to the other yet not finalized Dodd-Frank issues, hedging, pay for performance, and also the ratio, those are all simple disclosures. The clawback is the only one where you actually must implement a policy. The policy, the way the proposed rules, is very strict, very broad. It does usurp, in the end of a financial restatement, traditional roles that the board would play in that circumstance, as well as probably the Governance and Compensation Committee. But there are many complex and unanswered questions the way the proposed regulations currently stand. And note, although the head of the SEC said it's possible, they may just simply take the proposed rules, post them, and after the proper duration of posting them on the Federal Register, they would become the law. So that could happen, be somewhat alarming given the amount of open issues, but that is a possibility. I think the most likely outcome in this case, very simply, is that within the last couple of years, a large percentage, over 80% of large public companies, have already complied in intent with this requirement. They put in new clawbacks that they think will at least preliminary comply with the rules as they exist right now. So it does not seem proper that the SEC is going to spend a lot of time, effort to come up with new final rules that no matter what they do are going to be controversial, where the market has already for the most part complied.
And in fact, that's exactly what we've seen in the Canadian market, where there is no clawback legislation, but a very high rate of companies voluntarily implementing specific clawback policies.
So in addition to the clawback, the hedging rule and the pay for performance rules I mentioned, these are simple disclosures. It would seem pretty straightforward. Unknown why it's taken 6 years and we still don't have final rules on these pretty basic requirements here. The language out there, or the rumor that simply the hedging rule may be too broad, the actual couple sentences of the statute causing the unintentional result that business hedging might get pulled in. And for the pay for performance, the statute does allude to stock price, meaning it's probably TSR that is the appropriate means to measure performance under the statute, and some question that. However, it's still hard to imagine why there's been such a delay in putting this in place. I would expect that for the remainder of 2016, nothing is going to be implemented. The SEC is down a couple members, so there's no action being taken. No new members are being approved. So I think we're not going to have anything to 2017. If Republicans get in and win the contest, I think that you're going to see some continued delays here. Democrats win, I think you're going to see these two rules finalized pretty quickly. Perpetually, at any given time, there are a host of exec comp related legislation out there already on the board in proposed format. We took a quick look currently to see what's out there. There's at least 6 bills in the securities laws area pertaining to exec comp, everything from bills to repeal Dodd-Frank and the CEO pay ratio, to regulate proxy advisors, expand the SEC's analysis when it is coming out with new regulations, other SEC disclosure to update the proxy disclosure rules, and also then this golden leash NASDAQ rule, which actually has just been finalized, that we're going to talk about a little bit. In addition to the securities laws, there are additional areas where their laws are outstanding. There's a couple big tax laws that are out there. One of them pertains to Section 162M. There typically are a number of these at the same time, different bills. Some repeal, some expand, some redefine, and so there is currently one out here right now to eliminate the $1 million performance-based exemption, and there are major proposed rules out there on the 409A deferred compensation to further clarify this area. And finally, on the statutory side, there's a couple of additional items here, an EEOC proposal that would have a requirement that private sector employees collect and submit extensive employee data. And there's a proposed rule out there for incentive-based comp for financial institutions. This is extensive, complicated, have wide-ranging implications if you're a financial institution. Bottom line, a lot of legislation proposed out there. I would guess we're going to end up still with split Congress with continued gridlock, so I don't expect many of these, if any, to be ratified and become law anytime soon after the election.
When we start trying to predict the future, we see an interesting phenomenon in executive pay, particularly with respect to shareholders' say on executive pay. We find the U.S. in the middle, which is not where we usually find the U.S. U.S. companies are required to have a vote, but the consequences are reputational only. Canada, which is normally a leader on corporate and compensation governance, is lagging with a voluntary say-on-pay vote and with the regulator treading water. That said, though, voluntary compliance is very high, with all but the controlled companies in the TSX 60 having say-on-pay votes and more than half of the TSX Composite. The UK is now at the very far end of the spectrum and may be moving even further. We're going to spend a few minutes looking at the UK regulation as one possible future. UK legislation has admirable goals. The first three, pay for performance, decreasing reward for failure, and increasing shareholder engagement, all make sense, but they're pretty much motherhood and apple pie. The fourth goal is where the rubber really hits the road. It leads to the most important difference in the UK. Every 3 years now, shareholders get a binding vote on the company's executive compensation policy. Compensation decisions which are made and which don't comply with the shareholder-approved policy are void. This has some real teeth. In addition, in the UK, we still have an annual advisory vote on say-on-pay. This is all bolstered with some very different, interesting, and additional disclosure. In particular, companies have to disclose a 5-year look-back, which compares TSR with annual and long-term incentive payouts disclosed as a percentage of maximum. So this is getting to the point, or getting to the issue of what portion of pay are executives receiving and for what TSR results. As well, instead of CEO pay ratio, UK companies are required to disclose the change in that ratio year over year. And finally, there is a requirement to disclose the cost of employees, the whole of the employee population, the change in that cost year over year, and how that compares with dividends paid out and the change in dividends year over year. As well, in the UK, in the summary compensation table, there's a quite significant difference in how long-term incentives are disclosed. Instead of disclosing the grant date value, which we do in the US, UK companies are required to disclose the vested value, which will show not only changes in share price and how that impacts value, but also how performance conditions and whether or not they have been achieved impact pay. This should make assessing pay for performance a little bit easier. It's not clear if the UK legislation, invasive as it is having the desired effect. What we do know is that past legislative efforts in the US have generally not been effective to limit executive pay. Increased disclosure has, instead of curbing pay, caused significant increases in pay. The excess parachute legislation, which was intended to cap severance, has had quite the opposite effect. For a long time, any executive who was worth anything used the excess parachute limit of 3 times severance as the bare minimum, and contracts were drafted with tax gross-ups to eliminate the impact of 280G on executives. 162M, which was designed to limit deductibility for non-performance-based pay over $1 million, has not led to more performance-based pay, but rather to a jump in salaries to the $1 million mark. We're not sure what is going to happen with clawbacks, but the real fear is that because of the uncertainty in how the legislation works with performance-based pay, that the clawback rules will decrease performance-based pay. Say on pay has not been effective to decrease pay levels, but it does seem to be increasing the link between pay and performance. Interestingly, this is particularly interesting because say on pay does what it does through a risk of reputational damage rather than through a specific legislation or specific legislative consequences. When we ask ourselves if say on pay is working and take a 6-year look back, the results look surprisingly similar year over year. There are a small number of say on pay failures each year, very low number in 2016 with only 27 failures, and with 3/4 of companies consistently scoring over 90%. On the surface, this suggests that say on pay isn't doing much of anything. But underlying these very similar results, we have seen very significant differences in executive pay, both in terms of pay practices, lots of changes there, and also in the attention that compensation committees pay to particularly incentive design and target setting. The results may look static, but executive compensation certainly has not been.
If we're going to look forward in executive compensation to predict what's happening, you really do also need to consider what accounting changes might be on the horizon. And there are a few that I'd like to mention quickly here. First, FASB issued a new revenue recognition standard, although it's not going to be effective until approximately 2018, so we've got the year to think about this. It will have a material impact on when revenue is recognized. It's going to be a change, and thereby any change like this that's material will impact how you set performance goals under your short and your long-term incentive program to the extent they're revenue and or earnings based. So that is definitely out there, something to consider. So the next accounting issue to consider for executive compensation is the concept of a liquidity discount. When you're making equity grants, compensatory equity grants, we all know that you need to amortize the fair value at the date of grant over the vesting period. Question is, how do you determine the fair value? Some have argued that if you have considerable restrictions going into retirement, that is holding period for a couple of years and or vesting requirements that continue, that may have an impact on the economic or grant value up front, and thereby you could possibly decrease the fair value and thus decrease your accounting expense and make your earnings a little higher. This is, a lot of people have been talking about it. Very few have actually done this. Goldman Sachs is one famous one. They've actually done this for a couple of years, reduced their expense by several $1 million, given the amount of equity that they're granting. I think another question here, some organizations might even argue that the economic grant value maybe have a liquidity discount on it. So essentially, because the value at grant would be less from an economic perspective, you might need to grant more shares to get the same value. Frankly, I think that might be what's driving it. But again, not a lot of organizations have done this, but there's a lot of discussion out on this issue out there. The next accounting issue has to do with the use of non-GAAP measures. Almost everybody uses a non-GAAP financial measure. They're making adjustments to their GAAP financials for definitely for short-term and some for long-term incentive compensation purposes. And it's gotten pretty extensive to the point the SEC, they've recently indicated that they are going to have a study on the broad use of GAAP and non-GAAP financial measures. So it's something to watch for in the future. If they do come out with new rules or requirements on how you use this, what you might disclose, and potentially trying to reconcile the bridge between GAAP and non-GAAP that you're using, that we may see future required disclosure in the future. Finally, the last accounting issue I wanted to mention to you, at the end of March, we did have a new FASB release. pertains to the rules for stock-based compensation accounting. And although there are a couple implications here, and you must adopt all the changes, you can't cherry pick, the important one for executive compensation purposes is the tax withholding on equity-based compensation. Forever, for years, we've been allowed to withhold the statutory minimum, 25%, for federal tax purposes. Almost everybody has that hard-coded into their shareholder-approved long-term incentive plan, and it's always caused a problem. Executives having to pay almost 40% federal. There's a clear gap between what's withheld and what's due. Estimated payments are due, or at least some true-ups at the end of the year. Rather than doing that, now with this change, the accountants have said, well, without having variable accounting, you can now permit the maximum statutory rate, which is just shy of 40%, to be withheld. You would think this is a no-brainer, and by the way, FASB just came out and released that you can make this change without shareholder approval. They're not going to consider this to be a material modification, so you could modify your plan document with your board or comp committee approval, it seems, to allow for you to go to the maximum on withholding. Do understand, not only do you have to adopt all the other provisions within this release, some of those are listed below here, but also there's going to be a cash outflow for the company. Very simply, by doing cashless or withholding in shares, the company has stock, not cash, yet they've got to write a real cash check to the government for the withholding. So if you allow now double the withholding, obviously the cash outflow does double as well. That is an important consideration for companies.
Accounting treatment is one of a number of internal and external influencers on executive pay. This slide shows many of these other influencers. I'm going to focus in the next couple of slides on some of these key influencers. Activist investors, significant shareholders, and proxy advisors all look at similar things but have different approaches and different focus. Activists are very focused on pay for performance but do an in-depth review looking at a number of financial and other metrics. This in-depth approach is very different from the proxy advisors who have a quick check-the-boxes approach, and in the case of ISS, look only at total shareholder return. Activists are also looking for an opportunity to create shareholder value quickly. This means that they look for companies who are underperforming the market or their own potential. Significant shareholders, on the other hand, while concerned about pay for performance, often take a much longer-term view and are prepared to make investments in the long-term best interests of the company. These three groups also look at CEO pay very differently. Activists tend to look at CEO and executive pay as a percentage of value created and are much more tolerant of very high payouts where there's been a significant increase in share value. Proxy advisors always keep an eye on market median when they are assessing CEO pay levels and don't have this view that high pay or very high pay can be supported for very high results. As we mentioned, activists' focus is generally on companies that are underperforming. Executive pay is usually not a large enough number to move the needle in terms of share price or some of the financial modeling that they do. But it does, however, have terrific potential as a leverage point. It is the one area where there is an inherent conflict between the board and shareholders on the one hand and management on the other. Certainly we see shareholder concerns about executive pay increase significantly when performance is low, and this concern is really tailor-made for the activists' argument that the board isn't doing its job. It's not aligning pay and performance properly, or it's really just too cozy with management. Knowing all of this, how do you defend against an activist? It's pretty easy to set out the key principles, much less easy to implement them as a practical matter. But having things like a very clear alignment of incentives with strategy, having rigorous incentive programs with the sober exercise of board and committee judgment to make sure that the payouts actually make sense, and getting rid of problematic pay practices. There is no one right pay program that is immune from criticism, This issue is really less about design and more about how the pay programs work in practice each year in light of the performance results. Much easier said than done, but really the best defense is to be a high-performing company. As proxy advisors continue to increase their influence, and as activists become more a part of the mainstream corporate world, we expect to see continued pressure on executive pay, particularly on pay for performance, with performance defined in relation to what is most relevant for the business. We also expect to see an increased emphasis on performance-based, rather than fixed or time vesting, pay, and increased resistance to special retention awards, particularly when those awards are in restricted stock rather than in performance contingent long-term incentives. In the absence of regulation, we expect proxy advisor firms to continue to have a very real influence on executive pay and to continue to change the rules. It helps to keep them relevant. To increase the focus on incentive targets and payouts. This is probably the most challenging area for directors, and so it provides lots of opportunities for external criticism. To have a view, or to develop, a view on what is a reasonable and what is an unreasonable CEO pay ratio, and to continue to tighten up their rules for treasury plans. The landscape has changed dramatically over the last 5 years. We are seeing all of these trends now, whether it's an absolute total shareholder return cap in a relative total shareholder return performance stock unit. We are seeing increased share ownership requirements for CEOs and directors up to 10 times retainer or 10 times salary. Increased weighting to performance shares and a decreased weighting to options and restricted stock. Increased committee focus on performance measures and the stretch in those measures, and more recently, a real focus on what adjustments are made in assessing performance. We're seeing much more rigorous internal assessment of pay and performance, so compensation committees are getting a ton more material than they're disclosing on exactly how their pay and their performance align. And we're seeing post-retirement, post-employment holds. So executives and in some cases directors who are required to maintain a significant interest in the company after they resign or retire.
So given all that, what do we really expect looking forward in the executive compensation area? From a legislative perspective, I think we could all agree, particularly if Congress remains split between Democrats and Republicans, that we'll have ongoing gridlock. So there won't be a lot of new legislation. However, I do think we will have some changes here. I think you could expect the hedging and the pay for performance Dodd-Frank disclosures to be finalized pretty much without controversy. I do think you should expect higher tax rates for executives and no decreases in corporate rates, meaning those deferred compensation, voluntary deferred comp plans might be of interest to review going forward. And I do think this issue of repatriating profits from overseas is going to be a big lead issue for the coming year in 2017. I think a lot of countries cash-starved, looking for those dollars, are going to start trying to grab those. And I think the companies are going to realize that they're going to be taxed someplace. They'd be better bringing it to their headquarters back in the U.S. I do think that will be supplemented and incented by a special one-time lower income tax rate to entice those dollars back in. And that's going to have an impact on short and long-term goals on your performance programs. Finally, from a legislative perspective, this clawback policy under Dodd-Frank, it's going to be mandatory, it's going to be overbroad, and I think it's going to be implemented with much anxiety. And if that happens, which I think there is more than a passing chance, all of your programs are going to need to be reviewed, and all of them are going to be materially revised. So this might be the area where you spend most of your exec comp time in the trenches trying to revise and update your clawback policy if, in fact, this Dodd-Frank rule does become finalized in 2017. On the actual executive pay areas, what do we expect to see? Base salary, we've seen about a 3% structural increase year after year for the last 5 to 7 years. That will increase unless and until we get some material inflation going forward, which is not really expected. On annual bonus, more rigor in establishing the performance goals, that is a given. The pressure is coming from all sides, large shareholders, activists, investors, and proxy advisory firms. So count on that, spending more time really challenging the rigor of the performance goals on short and long term. On the long-term side, we are seeing a continued trend away from stock options, at least here in the States. We're down to now prevalence of less than 20%. I remember there was a time when it was almost 80%, but times have changed. Options are going to continue to fade away. They're just too dilutive for too long, typically having a 10-year life. And because activists in particular, big shareholders, proxy advisory firms, perceive it not to be performance-based, the market simply needs to go up for payout to occur. So the shift very clearly is to performance shares, anywhere from a half to two-thirds of long-term value on an annualized basis, with a mix between external measures, but right now that's a relative TSR, and internal GAAP-type earnings measures combined in those performance shares, the remaining one-half to one-third in full value shares, really to get shareholder alignment perspective and importantly retention, and that will be restricted stock units, not restricted stock. The change from restricted stock to RSUs has been incredible. I think we're approaching maybe 80% that are using RSUs. There's some very good retirement vesting income tax reasons for that, and also if you're granting outside the United States, RSUs not being property may solve some tax issues that you otherwise have. So I think there's going to be continued changes, the direction we're going, full value shares, a third performance, one-third RSUs.
Director compensation has changed too. Most companies in the U.S. have now moved to an all-inclusive retainer. This is simpler from an administrative perspective. It's also simpler from a disclosure perspective. We're seeing more director pay in equity even after share ownership requirements have been met, and pay is more tightly banding around the median as it becomes harder to support a director pay philosophy for pay above median. Higher share ownership levels and higher pay for compensation committees. And with all of this going on, it's clear that that's higher pay for significantly more work. Unlike executive pay, there is a strong move away from performance-based pay for directors, and that includes a move away from options, which to most people are considered performance-based pay. In response to some special arrangements that activists have suggested for their nominees to boards, including special performance-based pay only for their nominees, and sometimes performance-based pay, which is based on performance of the activist, not performance of the company, NASDAQ has introduced new golden leash disclosure rules. When we start looking further into the future, we start to think about whether we're going to see things like performance options, either to take advantage of the disclosure rules like Six Flags did, or to satisfy ISS's requirement that a portion of long-term incentive be performance contingent, a bigger emphasis on value sharing, how much of the company's value is being paid to the executives, and that's a reality in the UK disclosure now. Whether in addition to CEO pay ratio, we're going to start to see disclosure on how that ratio is changing over time and why, and possibly even CEO pay ratio caps, although CEO pay ratio is so dependent on the nature of the business that seems like it would be an irrational move. And then finally, binding say on pay. The UK is already halfway there with their binding vote on pay policy, and their new Prime Minister is talking about a binding vote not just on policy but on pay decisions. As this concludes our speculation on the future, we'd like to open it up to respond to your questions. To submit your questions, please type them into the Q&A box on the left-hand side of your screen. Our moderator, Linda, is going to read the questions, and Bob and I will do our best to answer them.
All right, and as we're waiting for our first question or two to come in, let me just kind of fill you in a little bit, the pay ratio, the CEO pay ratio under Dodd-Frank, because that is the only one of the four that are from executive compensation is finalized. And as we said earlier, you've got the fourth quarter of 2017 is when you have to run the calculation. And so what are some of our clients saying? What are they looking at here? How to address it? First off, when you do all this, what are the issues going to be? I think clearly if you have a high pay ratio, you're going to be in the press. But also another interesting issue that's coming out of that is once you publicize this, everybody's going to know what your median pay is. So all of your employees are going to see this publicly, and everybody below the median will know that they're below the median paid, and you may have other internal engagement issues inadvertently because of this. But I can tell you one issue I don't think you'll have is people questioning how you actually computed or came up with the median employee. Although that's the focus right now, and that's the challenge, how do you identify that? At the end of the day, once you do that and compute it, and you can lock into that person for 3 years, assuming you don't have material changes, I don't think that's going to be an issue going forward. But what are companies doing now? First, you have to really identify, assuming you have international locations, you have to identify what entities you have, what employees are there, and how you're going to collect the data from each of these locations. You may have different HRIS systems. Some places may still be even manual. So you've got to finally research and determine how you're going to collect data on a common basis from all these employees, and then determine which employees are going to be included and which are going to be excluded. You've got a de minimis exception you should think about, up to 5%, and also there's data privacy concerns. Countries where there are data privacy issues, you can exclude them, yet the de minimis exception adds to that. De minimis is no more than 5%. If you do exclude because of the data privacy, there's a lot more requirements you have to fulfill. So it's just not that easy to say you're going to exclude them, so keep that in mind. Then importantly, you have to decide what pay it is you're going to focus on to determine the median employee. You could do something simple as base salary, and note that's different than the pay used to actually compute the ratio. So to determine a median employee, you can use base salary, W-2 pay, taxable compensation, whatever really works worldwide on your systems that is easy, or you could be a little more strategic about that, and depending on what pay you use, you're going to get a slightly different answer. So you should be defining all of these things. You've got annualized compensation for part-time employees. So really get all your ducks in a row on doing the calculations. And then you have to go back and test the assumptions. You should do some sample modeling. Maybe what you could do with some of our clients, even though they have international operations, are running the test based on U.S. employees to make sure their assumptions are accurate and their systems work. And they're going to get a ratio then that they can test. The actual ratio is probably going to be higher if you're including international employees, although that's not a universal assumption, but at least give you a good test run and give you an idea where you might stand out. And finally, proxy language, the actual required disclosure is very minimal for this. Most organizations, I surmise, will put together a bigger story to explain the ratio and some of the implications. So that's kind of a quick overview of what to think about with the CEO pay ratio. So let me pause there. Do we have questions yet, Mona?
Yes, we've had one that came in. Do you think we will see more companies introducing performance options?
I'm happy to take that one, Bob.
Okay.
This question of performance options, really stock options that have performance criteria, does pop up from time to time. We don't see a lot of companies awarding performance options, but certainly I do get asked questions about this from time to time. The interest may be in part based on companies that are working to try and meet the ISS informal criteria that at least 50% of long-term incentive needs to be performance contingent. This coupled with ISS's view that plain vanilla stock options are not performance contingent and don't count. There's also a suggestion that some companies have been looking at more recently that if the goals are sufficiently challenging so that there's no likelihood of achieving the performance criteria, that performance stock options can be disclosed with a zero value. Whatever the impetus, we're cautious about performance options for a number of reasons. First, certainly in my view, stock options for most industries are already significantly performance-based. They really only have value if share price increases. So when you have performance options, you're really adding a second performance criteria or hurdle. Second, partly as a result of the fact that you have two performance hurdles, stock options may have a much lower perceived value to management than regular options. And certainly if you're getting into situations where you're saying these are very challenging to achieve, so challenging that they don't really have a value, you might question why you're awarding them at all. And third, there's real additional complexity with performance stock options. Fourth, any market-based conditions in stock options will require a Monte Carlo valuation with the attendant expense. Next, if you have significant performance conditions or very challenging performance conditions, that may materially decrease the value of the option either on a Black-Scholes or a Monte Carlo basis. That in turn increases dilution and increases leverage. Finally, because of the requirement that options have a fair market value exercise price, when you award performance options, you have to award the maximum amount, and then you take options away for any performance that's less than maximum. So even in a really strong performance year where you were performing at 175% of target, you would take some of those performance options away. That feels like a little bit of a disincentive. With that said, Linda, do we have more questions?
Yes, here's another one that came in. You said if taxes go up, deferred compensation plans would become of more interest and that we should therefore review them now. What should we be considering in our review?
All right, so yeah, that was my slide, so let me jump in here. So if you think back way in history, deferred compensation plans are actually widely used. The executives deferring bonus, typically a good part of it. A couple of things happened with some famous bankruptcies and loss or forfeitures, which deferred comp has to be subject to, so you're not triggering income taxation and obtaining the deferral. Along with that, then, the famous Enron case where top executives pulled their deferred comp money out with a haircut just before bankruptcy and the wheels falling off everything. They got millions of dollars. The result was then the Section 409A income tax rules. These are extraordinarily strict, very wide, broad rules, overbroad in my opinion, but you have to really make sure that your program, your deferred comp plan, is in compliance with these very complicated 409A rules. And it covers just the timing of the deferral election, the form and timing of the payout, if you're going to make any changes. Most organizations over the years, because there's been now 3 different sets of regs that have come out with this, over the years, most organizations have done a deep dive 409A review. So I would suggest you just go back, dot the I's, and make sure you're not inadvertently breaching the rules. There's some tried and tested practices now out there with the plans. Otherwise, you're going to accelerate taxation, be subject to a 20% excise tax penalty, and some additional withholding. So you really want to make sure that you've got this right from a technical perspective. Secondly, and very related, in the old days, these plans had tremendous flexibility. They mirrored the 401k plan where you can invest in 30 different mutual funds and change daily to the point where you almost needed a couple full-time people to administer this program for a very small number of top executives. So I would go back and make sure that you are not over-engineering the plan, giving too many alternatives. Have it pretty straightforward as far as the investment alternatives. It could simply be a prime rate or some other rate of interest and nothing more, or TSR, and you don't have to give choices of 50 investments. So make it straightforward, simple, and 409 compliant.
Okay, we have another question. Can you be more specific on the expected new rules from ISS on the CEO pay ratio test that they will come out with? What ratio will be good and bad?
Right.
Bob, I think this one's right up your alley again.
Yes, that was my forecast there. So note, that was purely speculation on my part. We're trying to look forward and predict what's going to happen here because that pay ratio, as I've already mentioned, is the law, just a matter of hitting the effective date. no more regulation or rules need be released to finalize it. It is an area I think that proxy advisory firms are going to focus on, yet nobody's done it yet. There's no disclosure yet for companies, so there's no data for them to actually work off of. Every November is when the ISS comes out with their new rules for the following year, so we should watch for that in November with that release. And I do suspect, if not this year, this time next year, once they have a year of practices, they might come out with something here. And again, I do suspect that they are going to do what they've done with some of the other rules, look at the peer group that they're establishing for you, and create points of comparison. So if you've got a 20-company peer group that they've established, they're already doing 3 of the tests top line to determine if they're going to do a deep dive on your proxy statement and holistic review. And I think they use the same peer group, look at the pay ratio results for that group, and simply create a percentage, different tiers, high, medium, and low, and then that will work into, once again, their say on pay. I think at first, I don't know that they can give you an automatic no vote, for example, but it might be in their quadrant test where you get some negative points or simply a point of focus going forward.
Okay, another question. Do you think that ISS and Glass Lewis will change their pay-for-performance methodology once the new rules respecting pay and performance are implemented?
I'd like to jump in on this one. I expect they will change their rules, and I certainly think that they should. The 2 biggest criticisms of how the proxy advisors do their pay-for-performance analysis have been, 1, how they select their peer groups, and 2, that they measure compensation using summary compensation grant date information. And the real problem with using the summary compensation table information is that when you have a really well-designed pay-for-performance plan with performance share units, and when compensation closely tracks share price and performance over the period of the award, the summary compensation table values don't show any of that. And so you tend to have a much weaker link between pay for performance if you're looking at grant date values than if you're looking at realizable pay. I mean, Glass Lewis has certainly addressed the peer group issue by switching to a sort of a peer of peers approach. ISS still uses their sort of GICS code formulaic approach, so still have some flaws in that. I think the reason to date that ISS and Glass Lewis haven't looked more thoughtfully at how you calculate pay in their pay for performance analysis is really just a practical one, and it's because it takes a fair bit of time and effort to try and determine some form of realizable pay. So once companies are required to disclose a consistent form of realizable pay, I expect that the formal methodology from both the proxy advisors will change. Even now, ISS will certainly reference realizable pay information that a company discloses voluntarily as part of its qualitative review process. So if a company discloses it voluntarily, even if they don't follow any particular format, ISS seems quite happy to look at it. I think once these new rules come in, the proxy advisors will adopt a changed formula. I think they want to have a better tool to measure pay and performance. Linda, did you want to read the next question out for us?
Sure. Why hasn't the SEC formally regulated proxy advisors?
Oh, that's an interesting question. And if you ask companies, they think that there should be much more significant regulation of the proxy advisors. I think the key here really is that the SEC has 2 very different interest groups that they have to consider on this tricky question of regulating proxy advisors. They have to look at companies or the issuers, but they also have to look at shareholders, and each has a very, very different perspective on whether ISS and Glass Lewis do a good job and what kind of regulation they should be subject to. Annual surveys actually show a quite dramatic dichotomy between how these 2 constituents really view ISS and Glass Lewis. Companies or issuers view the proxy advisors very negatively and find the conflict of interest issue particularly troubling. Most companies have a sense that ISS sets the rules and then wants to charge fairly significant compensation to help companies figure out if they comply with the ISS rules. If the SEC had only the company perspective to consider, I think that proxy advisors would probably be regulated very differently than they are. But they don't. They have to take into account the investor perspective as well. And exactly contrary to the view that companies have, investors consistently have the view that the proxy advisory firms perform very useful work. These two quite divergent views by the two key stakeholders really leave the SEC with no clear path to regulation that's going to satisfy both groups. Next question, Linda.
Okay. Skipping around here. How do we implement maximum income tax withholding on stock-based compensation under the new accounting rules?
That was mine earlier in the day, yes. So just to recap again, remember FASB came out with a new pronouncement that you now are able to withhold at the maximum federal rate. There are a lot of intricacies behind that, so it's not simply a question of moving from 25 to the 39.6 federal. There are state tax implications as well that you have to consider. But the good thing the accountants just did come out and explain that this is not deemed to be a, quote, material modification for accounting purposes, and thereby shareholder approval is not required to implement this. It pertaining to equity compensation, it is under your omnibus long-term incentive plan. So a simple modification or amendment of the program by your compensation committee, assuming they have authority, will suffice here. And then from that on, you just draw it into your long-term incentive program. So no shareholder approval is required. Do understand also, though, it's not just a question of getting the ability to withhold at the maximum. You have to accept the entire pronouncement. So there are some additional intricacies of that have to do with how you're accounting for the shares. And I think on an earlier slide I might have listed those without getting into detail. But just do know that there's more to it than just saying we're going to allow the maximum. Make sure your accounting department, tax department looks at this and understands the totality of the pronouncement, because you have to adopt the whole thing or none of it.
Okay, here's another question. Is pay for boards of directors too high, and why is it not appropriate for outside directors to receive incentive pay?
With the exception of a couple of outliers which have been very public, it's my own view that director pay is not too high. There are really a couple of reasons for this. Director pay is very consistently targeted at the median of the market, much more consistently targeted to median than executive pay, and increases year over year have been typically quite modest. At the same time as director pay has been moving gently upwards, the proportion of pay that directors receive in equity has been increasing, and share ownership requirements have been increasing. All of this is against a backdrop of significant increases in risk, responsibility, and time commitment, and increasing limitations on the number of boards that directors can sit on. So overall, in terms of pay quantum, I think that we've got a pretty good balance. On the question of why directors should not receive incentive pay or pay for performance, I think the real concern here, and one of the drivers in reducing, almost eliminating director stock options, is the concern that the director role is one of fiduciary oversight, and once you start paying directors based on the performance of the company, you start aligning their interests more closely with management, and you make it not necessarily in their economic interest to be that overseer, and to sometimes say no, and to be monitoring risk as closely as they're monitoring profit and performance. Do we have another question there, Linda?
And Chris, I think we're getting near the end. We might have time for a question or two, depending on what it is. But go ahead.
Okay, on the possibility of ISS tightening up its new share pool scorecard, this already seems to be happening, as ISS offered us many more shares if we agreed to eliminate liberal share counting from our plan. How does the SEC continue to allow a private firm like ISS to exert such undue influence over public companies?
Oh, let me take that one of my favorite questions here. So if any of you have gone through the process of getting a new share pool and try to go through the scorecard that ISS provided first in 2015, in the end, you do know that it is horse trading. So basically, they've got a number of provisions that they're looking at, that they focused on, that they want to see you add or subtract. One of them is the liberal share counting, and in my opinion, it's a very valuable provision. You don't want to give it up if you don't have to. But if you do it, they'll tell you how many additional shares they will allow you to get under their test if you agree to eliminate that. So, and there are a few other provisions like that. So you really need to think about what you need to give away to get the shares that you want. Of course, you want to maximize the shares, but not at the detriment of your future decision and operations with your long-term incentive program. But really get to the question, how does the ISS continue to be allowed to do this? The thing we have to keep in mind that they are a private firm, and they really are not in the business of consulting on executive compensation. You know, their clients are large shareholder groups, pension funds, mutual funds, who simply cannot research all the voting they have to do on all the shares that they own. So they hire an outside firm that does that for a living, these governance firms, and they pretty much, in some cases, just understand and agree the voting recommendation these firms come up with and go with that, although they are required to do a bit more due diligence than simply rely on that. So they are really advising their clientele, and by the way, exec comp kind of is part of that and gets in the way. So we have to keep in mind that they are not purposely consulting an exec comp. That's part of the test to determine if there's proper pay for performance. And I think that's kind of how, at least up to this point, they've kind of snuck under. And I think, Chris, you answered part of this as well in the past. So I think we're at the end of our time here. So I do see there's a couple more questions. We certainly will shoot you emails to the answer of your questions. And if you have more, our cards, our business contacts are on the next page. Feel free to call us or shoot us an email. And thank you much for joining us today in this webinar on future changes in exec comp. Thank you.
Thank you all for attending our webinar this afternoon. The slides are available for PDF download from the resource folder at the bottom of your screen. And if we didn't get to your questions today, or if you have follow-up questions, please reach out to us. Thanks very much.